Hello, 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 and happy Friday. Welcome back to yet another live event where we unpack passive investing, underwriting, deal analysis, governance issues one step at a time. So, let me offer a perspective that many passive investors and sometimes even some family offices may miss. A deal can be hitting projected occupancy, rent growth, maybe distributions, and still be the wrong deal. Why? Well, that's what we'll unpack today, and I'll share with you a few important nuances and my thoughts on the matter. But before we dive in, for those who may be tuning in for the first time, my name is Vessi Kapulian, former commercial lender who managed a pretty sizable, complex, multinational credit portfolio. Since then, I've started my own company and I have the pleasure of working with family offices and their family enterprises at the board level. I also selectively invest in multifamily and along those lines also work with private investors, business owners, high net worth individuals to help them vet deals with confidence and ease when they need the second set of eyes, or if they're looking to do a deeper dive in deal analysis. I also have a community that comes with a course that walks through the process step by step, very much in line with my best-selling book, Mastering Multifamily Underwriting: 5 Steps to Confident Risk Smart Apartment Investing, which is now a bestseller and also available on Amazon. But without further ado, let's get started. And what really comes to mind is weak reporting, and that's rarely a communication issue. In most cases, it's often the earliest visible signal of potentially weak asset management and discipline, internal controls and infrastructure, or perhaps even a sponsorship team that may not truly understand what is happening at the property level, which is even more concerning. And because when reporting quality starts slipping, it is often not the reporting itself that is the real problem, but it is what the reporting is quietly revealing about the operator and the operations of the property behind it. And so that's what I want to unpack in a little bit more detail. And a lot of it is coming from hands on experience and one on one conversations I've had over a long period of time, but especially in the past few weeks. So, first of all, just I think of reporting as a proxy for internal discipline. When I review deals, I don't only underwrite the market, the debt, the assumptions. These are, of course, very important to understand upfront, but I'm also underwriting the people and the systems behind the people, because at the end of the day, it's the people that make these deals run smoothly or not. And monthly reporting, monthly operating reports are really the window that illustrates what exactly is happening with the property and how the sponsor is performing relative to the business plan that they shared with you. So, what a strong reporting package would typically tell me is that the team is on top of things, that the data is reliable, there is accountability for decisions, early warnings or early red flags are appropriately picked up and addressed. And last but not least, there is respect for investor capital. Weak reporting usually reveals the opposite. And so, if the updates that I receive are late, maybe overly promotional, overly positive, maybe missing the uncomfortable details of the deal, I start asking why is that not being shared, or potentially what is not being revealed or shared. Because eventually, what gets ignored operationally then over time, it tends to show up financially. So here are the three things that I look for in the reports, and some are more detailed than others in terms of the sub-reports that they include in the data. Ideally, you would have the operating statement, the balance sheet, the statement of cash flow, believe it or not, is not always present. The key document here is the variance against the original projections. The original projections that the underwriting was based on. And what I really look at is the variance against those projections. I want to see what exactly moved. Is it occupancy? Is it certain expenses like payroll, contract services? Is it bad debt? Is it level? What's happening? How is capex progressing relative to the original business plan? Is it on track? Is it delayed? And most importantly, why? Why is there variance? And so, secondly, what I look for in these updates, to the extent that level of detail is shared, it's not only reporting on the problem, but talking about the solution, what transpired. At the end of the day, these are 5-7 year deals, so pretty long time horizon, and a lot of things could happen unexpectedly. That's just part of doing business. But the key is to really address those issues up front, and not only report them or announce them, but and share what caused them, right? So people have a appropriate perspective, but what is being done to actually solve the problem is key. And last but not least, how are these events impacting not only variance against the original projections, but how are they impacting the current state, specifically cash flow and liquidity? And that's where many operators may fall short. I've seen it happen over and over, especially as I consult with passive investors who need that second set of eyes on an existing deal. NOI is really not enough. You really have to dig 2-3 levels below NOI to get to the free cash flow of a property. And I had a prior live event on that. And even in last week's live, I touched on the topic. So if you'd like a link to the recordings of those prior events where I went a little bit deeper into free cash flow, how to get there, why it matters, just put it in the comments or send me a DM and I'll happily share that with you. So I really want to understand the free cash flow. And if it is negative, then look into cash burn rate and what are really the uses of cash and where the leakage is. And so why does that matter, you may ask? Well, for passive investors, the reporting quality is not just a nice to have. It is really your continued diligence process. After the deal closes, it doesn't stop. I had to break the news to you, but just because you're passive, right, doesn't mean you should fully disengage from the deal. As a passive investor, at least my thought process is that I have fiduciary responsibility towards myself. So even in the deals I'm passively invested in, I like to actively monitor those on a monthly or quarterly basis, depending on how frequently the reporting is distributed, because numbers tell the story, even if the sponsor is not forthcoming in their qualitative updates, which are part of the financial reporting package or usually come alongside with the financial reporting package. The numbers will tell you the story. So it's important to dig through and ask those questions early on to avoid surprises. So underwriting is really what got you in the deal, and reporting tells you whether the original thesis is holding up or not. And for family offices, this could also become a governance issue, right? Poor reporting, slow decision making, unclear portfolio level risk. It prevents timely capital allocation decisions, and timelines here are critical when we're looking at 7-8 figure checks. And so transparency not is not only communication. Of course, communication matters, but it is part of the overall risk mitigation process and protecting the downside. So here is a question that I will leave you with. What is the one reporting metric or one reporting habit perhaps that you've experienced that immediately increases your confidence in an operator? Or on the flip side, what is the one reporting red flag that would make you pay closer attention? And perhaps you've seen that with other fellow investors, or maybe one that you've experienced yourself. So add that in the comments. Would love to hear your thoughts, or you're always welcome to continue the conversation one-on-one with me. And of course, if you need a second set of eyes on a deal, I'm always happy to help and again connect one-on-one. That's what I do day in and day out, helping investors vet deals with confidence and ease. And I usually pop in Thursday or Friday afternoon for these brief live events where I share my thoughts on a current topic related to passive investing, underwriting, family office governance, and happy to share those with you. If you have a question or topic you're interested in, you're always welcome to either message me directly, or feel free to put it in the comments, and I'll happily work it in the pipeline and discuss it at future live events. And to be notified, don't forget to hit that subscribe button, the little bell, whether you're on LinkedIn or YouTube, which is usually where I come live. And I hope to see you at the next event. Thanks for joining and making the time today. Ciao.